Welcome to this issue of Retirement Crusaders. Could your bank fail? Maybe. Let's discuss a couple issues. Cash and reserves. How much cash does your bank have on hand? Very little. The average bank branch, say if it has 100 million or more in deposits, might have $200,000 of cash on hand. So like way less than even 1%. Why do they have such little cash? Well, they don't need it. They only need cash to put into the ATM machines and maybe on Fridays when people come in to cash their checks. But most people don't deal in cash anymore, so they don't need a heck of a lot of cash. In fact, if you had a $50,000 deposit at the bank and wanted to close it, you wouldn't want $50,000 of cash handed to you. You'd want to get one piece of paper, a cashier's check, that you could then take to another bank or securities firm or over to the car dealer. So cash is not really important in how much banks have on hand. And there's plenty of liquidity if they needed more cash. So just take an example. If somebody came into that bank and said, I have $1 million deposit here, I'd like it all in cash, they wouldn't have it on hand, but they could get it within a couple days because most banks have noticeably significant amounts on deposit at the Federal Reserve. So there's plenty of cash there. Although it's been declining, the amount of cash on reserve held at the Federal Reserve is about $3 trillion. So there's a good chunk of money there that if a few people want to cash in their deposits and get $1 million in cash, the bank could easily get their cash from the Federal Reserve and pay that money out. Fortunately, that never happens. The St. Louis Federal Reserve Bank estimates that banks hold at their branches about $75 billion of cash. What's that mean? It's about $230 for every resident of the United States. So not a lot. Why? Because we don't use cash very much, so they don't need to hold a lot of cash. And if they needed it, they could get it. Now, when you go to the bank a week after you make a deposit and say, can I see my cash? They don't have it. Why don't they have it? Well, banks make money by taking your cash and lending it to other people. They lend it out as loans on real estate. They lend it out as business loans. Or if they want to keep some liquidity, they'll buy treasury securities. So that's where your cash goes, because understand the business that the bank is in. They want to loan money out at 6% and pay you 2%. So that's how they make money. And that's why your cash isn't sitting at the bank, because they want to loan it out. And they keep just enough cash so that people who want cash, they have enough. Now, in addition to cash, physical money, banks normally keep reserves. So those would be things that can be turned into cash, on a pretty quick basis, okay? And it used to be, not too long ago in this country, that banks had to keep about a 10% reserve. So in other words, for every $10 you brought in, they had to keep $1, and the other $9 they could invest. They could make loans. They could, make loans on real estate, make loans to businesses, buy treasury securities, do all kinds of things. But 10%, they had to keep pretty liquid. Well, when COVID hit, the Federal Reserve made a decision. We want to make sure that there's plenty of money in the economy because there's this terrible catastrophe called COVID. So what they told the banks was, you know how before you had to keep 10% reserves? Don't worry about it. Now you don't have to keep anything. So if you look at this chart, this is the reserves required in different countries around the world in their banking system. So you notice, I don't know, what's it run? I can't tell what the average is here, 5%, 10%, 30%. But you did go down here to the United States. What are the reserves they have to keep? None. Now, that doesn't mean banks have depleted their reserves. They still keep a healthy amount of reserves, but you should know that our country, the Federal Reserve, says they don't have to keep any reserves. They, of course, the people who run the banks are pretty good business people, and they keep a reasonable amount of reserves to handle any liquidity needs, any withdrawals, anything they might need. Now, the thing to understand about our whole financial system is it works because everybody behaves. Now, what I mean by that is it works because not everybody shows up at the bank branch on the same day and says, I want to withdraw my money. Everybody behaves. So on an average day, in an average bank, what happens? Some people are making deposits, some people are making withdrawals. It pretty much levels out so the bank doesn't have to come up with any money because they paid out what they got in deposits. And that's a pretty average day for a bank, and that's why when things are going normally and everybody behaves, it's great. Any bank, if every depositor showed up on the same day to get their money, there's no bank in the universe that could give everybody their money for all their deposits. Why? Because again, they've lent it out. They don't have it. They help somebody buy a house. They help somebody grow their business. They lend it out to them. Or they bought treasury securities, which they could sell. Now, if you find these types of topics interesting and would like to see more, please hit the subscribe button below and then the little bell icon. So next time you log into YouTube, you'll see our next video, and we usually have one a week. Most of our videos are catered to retirees. People say, or people close to retirement, say age 55 and over. And if that fits you, subscribe below. Also, in the description, we have some educational booklets on retirement, absolutely free. Click that link, and a link to join our Facebook group so we can have discussions with other people in this stage of life about issues that you'd like to talk about. So join the Facebook group. Now, I want to make sure you understand this idea of everybody behaving. You need to understand that our financial system works because everybody behaves. So let me give you a couple examples of what I'm talking about here. Other people's actions impact you. You may wonder, why is it that when you go to the grocery store, the carton of eggs is $8? Wow, you think it should be only $4. Why is it $8? Because of your neighbors. If your neighbors go to the store and pay $8 and his neighbor pays $8, guess what they're going to keep charging for the carton of eggs? $8. So realize that the price of things is the price of things because of what other people do. Similarly, if everybody went to the bank and when they withdraw their money at the same time, then the whole system collapses. So the system works when everybody understands or everybody relates to each other in a reasonable way. And then it all works. It's only when people become unreasonable or they misbehave that there's trouble. So what happened at Silicon Valley Bank and why did it fail? Well, Silicon Valley Bank was in an interesting position. Unlike your bank, let's say it's Bank of America or Chase or Wells Fargo, those big banks have a lot of depositors from individuals, people like you and I. And you have your money there and it's worth $40,000 and they're only paying you 0.5% interest, and you don't look at it very often and you don't even realize, okay, they're paying me a lousy return. You just kind of leave it there because most people are lazy. So those big banks, they have lots of individual depositors who are not big shoppers. Most people do not sit there every day and say, I think I'll only need $12,000 in the next month. I'm going to take the other $28,000 and buy a 30-day treasury bill, and I'll get 3% on that treasury bill, and that way I'll make another, $400. Most people don't do that. And the big banks count on that because that way they get away with paying you 0.5% interest and charging somebody 6% a mortgage. It's good business. Silicon Valley Bank did not have a lot of individual depositors. Their depositors were sophisticated financial executives. They were companies funded by venture capitalists. So there may be a technology company that is starting a new piece of software, hardware, new technology, robot, ChatGPT, AI, something fancy with fancy letters. And those companies are funded by going to venture capitalists. So venture capitalist says, wow, we want to invest in your company. We think it's going to be really successful. So they say, here's $10 million. The company turned around and put it in Silicon Valley Bank because Silicon Valley Bank made their business of courting these startup companies and venture capitalists. Now, when Silicon Valley Bank pays 0.5%, the chief financial officer at those companies say, 0.5%? I'm going to pull that money out and go buy some treasury securities. So when a number of people decided to do this at the same time, and another problem was happening at the same time, which is this. In 2022, the stock market wasn't very good. Stocks are going down in value. Particularly technology companies, as you see, are laying off people. So it's not a great time for technology companies, which means venture capitalists are not funding new companies. Where did Silicon Valley Bank get their deposits? From venture capital investments. So here's what happened with Silicon Valley Bank. Because the venture capital market was drying up, they were getting no new deposits and people were making withdrawals because they could earn interest elsewhere. Now, Silicon Valley Bank had money in treasury securities. So to pay off these people who wanted to move their deposits, they sold some treasury securities. There was just one problem with that. So here's the problem. You'll see on this chart, let's say Silicon Valley Bank bought treasury securities here when the index, we'll call it an index, when the price was 130, we're using this axis over here. Let's say that's about 136, right? So they bought the treasury securities when they were paying, the price was 136. Now let's say Silicon Valley Bank bought $100 million of treasury securities and they were 10-year securities. If they bought them at face value, they'd hold them for 10 years and they would pay off at face value. They couldn't lose any money. That's the beauty of treasury securities, if you hold it to maturity. But what happened was Silicon Valley Bank bought these treasury securities, and then what happened to the market price of the treasury securities? Well, here they bought them at 136, and now here they are today at 110, 112. So they pay 136, they sell them at 112. What's that, about a 15% loss? That's the problem. They were forced to sell these treasury securities at a loss, and they only had so much to do that with. The rest of their money was illiquid. It was in places they couldn't get at it, say loans. And that's why the FDIC stepped in and said, you don't have the money to pay your depositors given the amount of demand for withdrawals. And they had to take over the bank. Could something like that happen to your bank? It's possible, but unlikely because your bank doesn't have that kind of profile. If your bank is Chase, Bank of America, Wells Fargo, they have a lot of individual depositors, a lot of people who are unlikely to all want their money at the same time. And on any given day, these banks have about as much money coming in as deposits as they have going out in withdrawals. So these larger diversified banks who have a bigger retail clientele are pretty insulated from the kind of thing that happened to Silicon Valley Bank. So if I were you, I'd sleep pretty well at night. I really wouldn't worry about it. Now, if you find these types of topics interesting and would like to see more, please hit the subscribe button below and then the little bell icon. So next time you log into YouTube, you'll see our next video. And we usually have one a week. Most of our videos are catered to retirees. People say, or people close to retirement, say age 55 and over. And if that fits you, subscribe below. Also, in the description, we have some educational booklets on retirement, absolutely free. Click that link and a link to join our Facebook group so we can have discussions with other people in this stage of life about issues that you'd like to talk about. So join the Facebook group.